Multi-green, building attainable, sustainable, and tech-enabled multifamily real estate through impact investing.
Welcome to the Multi-Green Podcast. I'm your host, Randy Norton, and today we'll be speaking with a Yale PhD-trained researcher, inventor, economist, and scoutmaster, Brad Case. Brad served as a senior economist at Fannie Mae, held a similar position at NAREIT, and is co-inventor of the FTSE NAREIT index methodology. With over 25 years of experience in public equities and private market alternative investments, he has specialized in residential and commercial real estate. Brad is sure to impress. Enjoy our conversation. Brad, thank you for being on the Multi-Green Podcast today.
Oh, it's my pleasure.
You and I first met telephonically in the summer of 2017, I believe, when I was researching for a solution for REIT research, and you were at NAREIT at the time. Is that right?
Yes, that's right.
And recently you and I connected again, and it appears that we have another thing in common.
Yeah, we are both involved in Scouts. And in fact, when we were talking about it earlier, you mentioned Boy Scouts of America, which is what it has been for more than 100 years, except that it's now changed. There are now girls, and there are now even girl Eagle Scouts. So we call it Scouts BSA now, but I'm really happy that you and I are both involved in that program.
It made me who I am today. It taught me how to be a better person, return things better than you found it, and be efficient with resources. And it was just, it taught, I think, me how to learn, actually. So I'm glad you're doing that. Now you're in Hawaii, is that correct?
I am. My parents are, my dad is 8 months past his 100th birthday. My mom is not that far from hers, but they are both still living independently. I, though, came out to spend a little bit of time and help them set up a few things so that it'll be easier for them to do that.
Remarkable. Now, is there any truth to the blue zone theory and any relation to Hawaii and the longevity there with your parents?
Well, the life expectancy in Hawaii is longer than most other places in the country. Not all, but most. I think a lot of that has to do with being outdoors a lot. And of course, when we come to COVID, it's nice that people in Hawaii are able to control the entry of people from other parts of the world. But also, they spend a lot of time outdoors. And so that, especially during the winter, that really gives them an advantage, both in terms of dealing with COVID and also in terms of more general life expectancy.
Well, Hawaii is definitely paradise during the winter.
I love it here. So
looking at your illustrious career and chances for learning, you have some really amazing things on your resume. Top of the list, PhD at Yale. Obviously, you completed your CFA and Kaya designations. What are you most proud about?
Well, that's a great question. I guess I have to say that I am most proud of getting my PhD at Yale. The CFA and Kaya were almost equally difficult, but the quality of the work that I was able to produce at Yale was terrific. I'm very proud of that. I got to work closely with Bob Shiller, who has won the Nobel Prize in economics. He was the reason I went to Yale, and he was one of my dissertation advisors. Will Getzman, who's an equally brilliant person in terms of finance and real estate, and incidentally art, was my other dissertation advisor. So the opportunity to work with Bob and Will was just terrific.
Now, some listeners might trigger the Case-Shiller index because your last name is Case.
Indeed. In fact, I am not that Case. Chip Case, who taught at Wellesley College for a long time, died a few years ago, a good friend of mine. However, I co-developed a competing index methodology, which is called and was called the Case-Quigley methodology. John Quigley taught at Berkeley while I was there. And so the confusion between the Case-Shiller index methodology and the Case-Quigley index methodology trapped even my dad, who started bragging about me when the Case-Shiller index started being published in newspapers. So I had to correct him on that.
That's great. So now you're surfing in Hawaii.
So to speak.
But before having fun in the sun there, you were recently a senior level economist at Fannie Mae. And prior to that, a similar senior level economist at NAREIT, correct?
Yes, that's right. And in fact, so together, that's 13 and a half years of my career. Before that, I was at the Federal Reserve Board in Washington, D.C. And in all that time, I was researching real estate markets. So that's been a continuing interest of mine. In fact, I remember my first interest in real estate coming while I was in high school, which sounds really geeky, and it is. But what's nice about my career is that I've been able to attack that chief interest from a whole bunch of different perspectives. At times, I have focused primarily on single family owner occupied housing. Other times, I've focused primarily on commercial real estate, retail and office and industrial and things like that. Other times, I've focused especially on multifamily real estate. And my focus has sort of from measuring values the way they are measured on the private side of the market, measuring returns the way they are measured in the public markets, that is the stock markets, even when you're investing in real estate, focusing on green real estate investment, all sorts of different ways of thinking about that big broad topic, real estate, that's been my interest essentially my whole adult life.
It's fascinating. One of the most multidisciplinary asset classes in the world, one of the largest asset classes in the world. So in your opinion, is real estate an alternative or a traditional asset class?
So I would say it is an alternative asset class, and there are very few other alternative asset classes. And what I mean by that is, for example, private equity is not an alternative asset class. It is an alternative way of measuring the returns to the equity asset class. So stocks are equities. Private equity is also an equity investment. Now, in real estate, you can invest in real estate through the stock market by buying stock in a REIT, or you can invest in real estate on the private side of the market. So that's the same. There's the same distinction there between public and private real estate that there is between stocks and private equity. Now, so what is it that makes real estate an alternative asset class? Well, it really comes down to what is the cycle that drives values of those assets up or down. And in the stock market, there is a cycle. We call it all sorts of different things. Sometimes we call it the inventory cycle. Sometimes we simply call it the stock market cycle. But it is a set of earnings drivers that at sometimes drive stock prices up. And again, equity prices, so private equity too. And at other times in a recession, those stock prices and equity prices are driven down. Real estate also has a cycle, but it's a much longer cycle. And the reason it's much longer is that it will take roughly 4 years on average to put up a new building, which is to say it takes a long time to adjust the supply in that market. And if you contrast that with almost any other part of the economy, even if you're running, for example, an auto company, it takes a matter of months to adjust the supply that you're delivering to that market. So it's the fact that it takes so long to put up a building that causes real estate to have a fundamentally longer cycle than the cycle that affects equities, which is to say stocks and private equity. So I would say it's an alternative. The other assets that we think of as alternatives are not necessarily alternatives. Private equity is simply a private way of investing in equity. Hedge funds are simply a way of investing in a whole range of assets. So there are some other assets that I consider alternatives, and commodities are, I would say, the main one. But private equity and hedge funds are simply not alternative assets.
That is one of the best explanations I've ever heard. I also follow your comments on social media, specifically LinkedIn, and you are a fierce participant. Oftentimes, you correct and comment on fake news or false narratives, and you have even published a series on LinkedIn. And I don't want to spoil it for our listeners. Can you opine?
The series that I was publishing recently, in fact, the only reason I stopped was that I showed up in Honolulu to help my parents, and I'm busy enough out here that I haven't been able to finish that series. But that was extracts from a paper that was just published in an investment-oriented academic publication called the Journal of Investing. And it was the Journal of Investing published a special issue taking a critical look at private equity. So we're not talking about real estate here. We're talking about private equity. And really, this special issue posed the question, are we understanding private equity correctly? And so my contribution was a very simple one. I took about 70 or 80 published papers by academics, but at any rate, using an academic methodology and actual data to ask the question, have private equity investments performed for investors? And I tried to be fair and comprehensive. And so there are some papers in my bibliography that say private equity has done great. But the vast majority of empirical research on private equity has reached the opposite conclusion, which is to say people who think that they have gotten good returns in private equity are deluding themselves. And private equity managers who claim to have gotten good returns in private equity are, generally speaking, deluding their investors. And so I don't want to suggest that private equity cannot be a good way of investing, but there are few, if any, investors who have really done better in private equity over a long period of time than they would have done in public equity, that is stocks, by taking the same amount of risk. And so my hope is that going forward, people will continue to take a critical look at that asset class and get and look at the data that they need to figure out whether they're doing better in private equity than they would have done with the same amount of risk in public equity. Because generally speaking, the answer to date has been stock investments have been better.
Mm-hmm. Well, I thank you for that narrative. I could go down a rabbit hole here about fees and structures and private equity. And we saw the same thing at our single family office on a time-weighted return series on an after fees, after tax basis. There were so many ways that the returns were manipulated. We just said no more. And we have a lot of public equities and a lot of real assets because of it. And there's just, a lot of pejorative, I think, takeaways now happening in the hedge fund or private equity space. And there definitely is a shift of people wanting to disintermediate or reorientate fees and get closer and closer to the asset. And Ashby Monk on a previous podcast or on another podcast basically stated in his books that, that's his whole goal is to get institutional investors to get closer to the asset, do direct investments, co-investments, and if nothing else, to have alpha reduce the fees. Would you agree with that narrative?
Oh, absolutely. In fact, there is an organization called CEM Benchmarking that's based in Toronto, Canada. They have made it their focus to look at different ways of investing in the different asset classes to figure out where investors are getting their money's worth. And some of their work has said disintermediation is very important. If you can do a private equity program in-house, for example, they have found is better than doing a private equity program through investment consultants, and way better than doing it through funds of funds. So that the question is one that I think institutional investors need to ask, and need to ask very quickly, because the money that is supposed to go to the beneficiaries of a pension fund or the financial aid students whose financial aid is supported by an endowment, or the cancer patients who are hoping to benefit from cancer research that's being funded by foundations. Those beneficiaries are losing out because of all the money that's being wasted in the process of making these very costly investments. Now, having said that, I do want to point out that, in my opinion, high fees are not necessarily bad. The reason they're bad is that they are not coupled to better performance. And what's happening, and my real focus in looking at the investment world is on risk, because my pet peeve about private equity is that the fees would be justifiable if the investment managers were not taking large risks. But the fact is they're taking huge risks on behalf of their investors and charging very high fees that are not justified given the amount of risk that's being taken. Although the fees are too high, they're too high only because the performance has not been there, but the investment managers are simply hiding behind easily manipulated performance metrics. And the institutional investors are not digging deep enough to root out that misrepresentation. And the people who are in positions of fiduciary responsibility are simply not exercising their fiduciary responsibilities diligently enough to root out that misrepresentation of risk.
One of my favorite things to do is really look at performance and the return composition. And once you understand that, wow, it's just really enlightening. And your investments will change going forward. And that's really why we created Multigreen. We could not find anyone in this space doing it the way we wanted to do it. And most sponsors that we were backing would try to exit as quickly as they could, 3 to 5 years, realize a very hefty promote. We had very little cash flow during the time. They said, hey, you got a 19% IRR or something.
Yeah.
Well, they take home the fees. And then, by the way, we're in California sometimes. And after tax, your return is cut in half. It was just a very tax inefficient way to invest.
Yeah, and I've noticed the same thing. And so it's great from my point of view that you're able to set up this platform to try to eliminate some of those problems with the fee structure and the incentive structure. I mean, one of the things that really bothers me is that often a successful investment will be the first one exited. Not because it's not going to continue to be successful, but because there's risk to the investment manager. Whereas if they exit it immediately, they can report a tremendously high IRR in time to raise the next fund. So as I said, the performance metrics are so easily manipulated. And the truth is that they are often manipulated to the detriment of the investors.
I love your insight. Amongst all of the responsibilities you've had, specifically even at NAREIT, you had some front row seats to this ESG evolvement and sustainable investing in real estate. Where do you think it is now, and where do you think it's going to be in the future?
Well, I think we're still in very early days. One of the questions that had to be answered, and that still really has to be answered, is ESG investing going to be better from a purely returns point of view? And if so, why? And so we've started to answer that question. Tenants want to be in green buildings, and they are willing to pay higher rents than otherwise if the building is green, because they are contributing in that way to some green solutions. But that doesn't mean it's easy to make money by buying a green building. If you buy a green building, then you're paying for the higher rents that tenants are going to pay you in the future. You can't make money that way. The way you make money is by developing a green building or renovating a green building to make it green. That way you capture the higher rents that the tenants are going to be willing to pay in the future. So I think that some people who want to portray themselves as green investment managers in real estate are sacrificing returns by simply overpaying for buildings that are already green. And then the other issue that I dealt with very, very explicitly at NAREIT was, investors who want to make green investments in real estate. I mean, how do you do that? When you invest in real estate through REITs, which is to say by buying stock on, in publicly traded companies that primarily own real estate, you can choose REITs who own portfolios of buildings, more of which are green. And that's a great way to invest. But how do you measure it? And so we worked on developing an index where the weights on the index would correspond to how green each REIT's portfolio was. We were not able to make that happen while I was at NAREIT. The reason is that when you have something like that, I mean, there are going to be winners and losers. And the problem was that the measures of green properties were not well enough developed. They were originally developed really by people who had a lot of interests other than simply green investing. And I'll give you an example. In the early LEED standards that were set up by the U.S. Green Building Council, one of the key pieces for multifamily properties was tenants have to be prohibited from smoking. Is that something that should be considered in evaluating whether a property is green? Well, maybe it should and maybe it shouldn't, but it's not obvious. And so the conversations are very difficult conversations, and it was going to take years to really come up with an appropriate way to measure whether the buildings owned by a REIT are green buildings. And so LEED is a perfectly good way to do that. And it's, I would say, the best way to do it. But even LEED is still in the early stages. So we're getting better and better. What I think investors really need to guard against is investing in a company because it has a very aggressive marketing program that portrays it as green. There's a big difference between doing something that actually helps the planet versus doing something that makes you feel as though you're helping the planet. And if you're going to bother with green investing, then you need to make sure that you really are helping the planet rather than just helping to reward people who put together convincing marketing programs.
I agree. There's a lot of greenwashing out there, and that is one of the problems. Over the last 10 years, we didn't even really believe in it. And now, because the frameworks are getting better and we know how to implement it, and we have a reference in our data centers, we want to do it. And I hope and I think that as the operators and the owners become more aware and educated on this, I think they're going to just demand it. And this is going to be the decade, I think, for change.
I absolutely agree with you. In the early days, basically, people knew it was going to be difficult and sort of a long-term investment to make their buildings really better for the environment. And so the shortcut was simply to claim to be green. But that won't help for very long. There was always sort of a lot of heavy lifting that was going to be required to give investors the opportunity really to make green investments. That is well underway. And as you say, the next decade will be the key decade for that.
Do you think this phrase of sustainability and attainability is oxymoronic, or is it possible that they can blend together somewhere?
Oh, they absolutely can blend together. But again, I mean, if these things were easy, we would have done it 100 years ago. They are not just attainable, they are sort of natural allies. A lot of the households in this country really do care about preserving the planet for future generations. They really do. But a lot of them don't have the money to contribute to environmental causes. The way that they can contribute is by choosing housing that they can afford, but is also something that is going to help protect the environment for future generations. I think there's a lot of desire among households to be able to make that kind of choice. And so sustainability and attainability, we can solve this problem, and we can solve it in a way that enables everybody to contribute, not just the super rich, but everybody who wants to contribute to the problems of preserving the environment.
And sustainability is not just about the environment. It's also about social aspects
Absolutely.
and governance aspects and reporting. And what I've learned is you have to even exit an investment responsibly, which is sustainable. And there's so many aspects to go into this, but I think we've covered sustainability really well. Can we talk about attainability for a minute?
Yeah, I mean, this is a difficult issue. And so I think that one of the reasons that it's difficult is that we all have aspirations, not just for ourselves, but for everybody. Nobody wants to see other people living in a housing unit that they wouldn't want to live in themselves. But what that causes us to do is to increase the standards so that basically we're trying to make it so that nobody is living in housing that I don't want to live in myself. And that makes it expensive, and that makes it less attainable. And that's a shame. But as a society, we are getting more and more economically secure, and that makes it possible for us to ask for higher quality housing. And so we're doing that. But the way to do that is in fact, I think very important part of the solution is new technologies of building housing. We've been using the same technologies for well over 100 years, even for high-rise buildings. But there are people who are very aggressively looking for better building technologies that will enable us to build houses that don't fall down, don't go into disrepair as easily, but that are also not as expensive and therefore more attainable for most households. And I think, again, over the next decade, that's something that we're really going to see is something that makes it easier to put up housing that is more affordable to people and still very good looking, very pleasant to live in, and also very pleasant to think of other people living in. Once we see the success of those new building technologies, then the problem to attack is the building regulatory environment that was constructed 50 years ago, when what we were really trying to guard against was substandard housing, but that make it very, very expensive to put up a building, even when the building technology itself is not expensive. So I think there's a lot of work to do there. There are some really exciting developments recently in building technology, and that are really going to help attainability.
When you were at Fannie Mae and you were back in Washington, D.C., this has to be on the forefront of everyone's mind, whether it's Fannie or Freddie or HUD. What is the government's approach and mindset in those hallowed grounds? And what have you learned? And how can we provide a solution going forward?
So what is the government's fundamental role? Well, we don't want anybody not to have housing because they can't afford it. It just, as a society, that is something we want to eliminate. Because we make that commitment, we are not willing to allow the mortgage industry to collapse. In 2008, 2009, the mortgage industry came very close to collapsing, and Fannie Mae and Freddie Mac with it. And so the government was going to step in and make sure that didn't happen. And that was the appropriate thing for the government to do. You simply cannot let an industry like that cease to exist, even for a short time. However, when you have that commitment, it enables companies to abuse that commitment by taking too much risk. And that's exactly what Fannie Mae did, and that's exactly what Freddie Mac did. And so as a government, we need to be able to make sure that companies like Fannie Mae and Freddie Mac are behaving responsibly. And so, the government is never going to be perfect, but it has taken on the role of looking over the shoulders of companies like Fannie Mae and Freddie Mac to make sure they're not taking on too much risk. And, we were talking earlier about how much risk is being taken on by pension funds and endowments and foundations with money that should be going to their beneficiaries. So that's another situation where the government is not as heavily involved. And what we are seeing is too much risk. So I'm grateful that the housing market has this explicit oversight from the federal government to make sure that that much risk is not taken again. We were all blindsided by what happened in 2008, but lots of us had an idea that the risk was getting too great. We just didn't know how bad the collapse was going to be. And the federal government needs to be able to make sure that that kind of risks don't affect people going forward.
Can I share with you 4 or 5 headlines that I recently read, and you can verify if it's a true or false narrative?
Sure.
Number 1, homeownership in the United States is at an all-time low. Thoughts?
For several years, the federal government was blindly supporting the goal of homeownership, and that's not the appropriate way for everybody to live. There is this myth that owning a home makes somebody a better person in some way. Maybe becoming a homeowner makes you more likely to keep up your property, or maybe becoming a homeowner makes you more likely to vote, or whatever it is. Economists have been looking for decades for evidence that becoming a homeowner makes people better in some way. And we have been unable to find it. So I think that the fact that homeownership has gone down since that crisis is not necessarily a bad thing. It can be too low too, but it can absolutely be too high. And I think before the crisis, the reason that Fannie Mae and Freddie Mac were able to take on too much risk is that the federal government was trying to push them to do their part to push the homeownership rate above where it should have been.
Next factoid. There is 4.6 million units short in the United States today for housing stock.
One of the difficulties is simply how do you measure that? At any given time, there are going to be vacant housing units. And it's the same reason that at any given time, the unemployment rate is not going to be zero. People are between houses, just like they're between housing units. There are other housing units that should be torn down. They're too old, they're too dilapidated. They are still counted as housing units, but they are vacant. At the other end, you have families living together that would certainly prefer to live in separate housing units. And so one of the things that happened as a result of the housing crisis of 2008, 2009, is that the rate of new household formation plummeted and stayed down for years and years. And what that means is that a lot of people who are just out of college were living with their parents when they would prefer to have rented their own place. So in that sense, there's always going to be a shortage of housing units because people who are currently doubled up would rather have their own place. What's going to make it possible for people to have their own place is the economic security, the financial security, so that they can go and sign a one-year lease. What we want is to make sure that there are enough, especially rental housing, so that nobody is forced to double up with people that they don't want to double up with, such as their parents.
That's right. Here's another fact I just read. With trying to keep up with the household formations, we are 370,000 units short each year. And you can measure that again in many different ways. Are we building enough housing in the United States?
I would say the answer is no, we are not building enough housing in the United States. And you can argue about sort of why we have reached that point. But here's what I would say. Laws are made by people who are actively involved in the political process. To a great extent, the people who are most actively involved are the people who already have the housing that they want. And so the people who need additional housing are the ones least likely to be involved in the political process. Now, so when we have regulatory regimes that are too strict, and I'm not talking about every part of the country, but I'm certainly talking about certain parts of the country, those regulatory regimes were set up by the people who currently live there. You look at a place like San Francisco, you look at a place like New York, you look at a place like Boston, very strict regulatory regimes that make it difficult and costly to develop new housing units, especially for lower and moderate income households. Why? Because keeping the number of housing units low benefits the people who are already there. And those are the ones making the rules. So we are going to have to accept the idea that we want to make sure everybody has an opportunity to get housing. And by that, I don't mean we need to make sure everybody has the opportunity to buy a house. Not everybody should be buying a house. We need to make sure that everybody has the opportunity to get adequate housing. And that's going to come from developing housing, even in places like San Francisco and New York and Boston.
Excellent point. Okay, my last headline. Somewhere I read that there is only about 50,000 affordable units created each year in the United States, and that is with the private activity bonds and subsidized housing, tax-exempt financing, and the like. However, we lose about 125,000 units a year due to units falling out of compliance, making it a net loss of 75,000 affordable units a year. Is that accurate?
I don't know whether that's accurate. It's not absurd. It may well be accurate. You know, think about one thing that people have to keep in mind is, where does affordable housing come from? And we often think the way we need to increase the affordable housing stock is to have developers build new affordable housing units. And that's a very important piece of the puzzle, but it's only a piece of the puzzle. Most affordable housing was originally built as expensive housing. And in time, those houses were subdivided into condominium units, or they simply became less desirable because of their design. You know, houses used to be built with, even expensive houses used to be built with much smaller rooms or much fewer bathrooms, things that we now think are not desirable. And so that housing becomes more affordable. Now, so there are multiple ways of making sure that there is more affordable housing. But what happens with the affordable housing stock? Well, some of it is torn down to build expensive housing. And that's one of the ways that affordable stock is lost. But I don't know that it's the main way. If I were to guess, the main way that we lose affordable housing is that houses that were built a long time ago as expensive houses and that have become affordable over time become not livable. That's a function of building technologies. Houses that were built all wood by hand from the ground up on site, you know, they just didn't live forever. Those houses didn't live forever. But as we get better at building new housing units, even if the new housing units are expensive when they are first built, when they become affordable, they won't fall apart. And so that's a major piece of solving the general affordable housing puzzle. So I think that this is one of these situations where we need to attack it in several ways. We need to attack it as, let's get more affordable units built. We need to attack it as, let's make sure that the units that are built are going to be usable for a long time. And let's attack it as, we need to make sure that we are not excluding new housing development of any kind, because more supply of housing means more households that are going to be able to find something attainable.
Fascinating. How would you define attainable housing?
Years ago, I was asked to referee an academic style paper that talked about how much housing was attainable in different metro areas in the country. And they started by defining, what does it mean to be middle class? And then the idea was, how many people can afford a middle class lifestyle in each city? And so the way they defined middle class is, they did it with focus groups. And what people said is, all right, I think that what it means to be middle class is, number one, I can afford a normal house in this city. All right, so that makes perfect sense. Number two, and afford to buy a normal house in this city. Number two, I can afford to send my child to whatever college they get into. And number three, I can afford to save enough for retirement. And I shredded this paper. And I said, listen, anybody who can afford all three of those things is not middle class. There you've defined upper class. And so what people in focus groups are doing is saying, I wish that I could afford all these three things and still call myself middle class. But that's not what it's like. In life, we have to make choices. And so one of those choices is between sending my kid to whichever school they get into versus buying the normal house in my city. Now, where I live, there are lots of people who have made the choice to buy smaller houses, more affordable, more attainable, because what they really want to attain is the ability to send their child to whatever whatever college they get into. And that's great. I'm not going to make that choice for other people. So what does it mean to be attainable? It means it's realistic for a person making realistic choices to do that. And so if you're talking about an unrealistic choice, I want a 6,000 square foot house close into the downtown area so I have a very short commute. And by the way, I also want to be able to send my child to Princeton. Saying that is not attainable does not bother me, because it shouldn't be attainable. That's not a reasonable desire.
That's such a great response. I want to tailor these next few questions about REITs maybe in a more multifamily specific way, instead of just, open to all REIT styles and types. So if you can think about that, when you're looking at annual reports and you're trying to understand good REITs or bad REITs and valuations, can you give us a 101 on valuations and maybe some ideas for things that you pull out of 10Ks from a reporting standpoint that you think that are just fundamental that everybody should know?
Yeah, when you're investing in a REIT, you're investing in a portfolio of properties that is professionally managed by that REIT. And so the key question is, what are going to be the future net cash flows from owning those properties? And did they pay too much when they bought those assets or developed them? Or did they develop them at a good price or acquire them at a good price? And so, I often say that there are 7 basic ways to create value in real estate, which also means there are 7 basic ways to destroy value. The first and, the most obvious 2 are when you buy a property and when you sell a property. Now, I hope I'm not going to insult some of your listeners by saying the real estate industry is full of yahoos. and And there are several ways of identifying the yahoos. One of them is people who brag that they never sell a property. The point they're making is, I've never made a bad decision, so I never have to correct the decision. That's exactly the wrong way to think about things. It is always potentially a good decision to sell a property, just as it is always potentially a good decision to buy a property. But it is often potentially a bad decision to buy a property. And for a lot of property investors, the biggest mistake they make is to buy a property when they shouldn't. You ask them about the process that they go through in acquiring a property, and they talk about how it's location, location, location. It's really not. It's really timing, timing, and timing. Because if you get caught up in the frenzy and buy every property in sight when everybody else is competing those properties, which incidentally is exactly what a lot of institutional investors were doing back in 2007, then you're destroying value. In contrast, if you sit back on the sidelines and say, you all go and fight about those properties, I'll wait until the crash and then I'll buy them then you're going to create value. So the first two ways of creating value are choosing the best time to buy and the best time to sell. Now, once you've chosen the best time to buy, then of course you want to pay attention to which property you're going to buy. But the first question is this a good time to buy? Now, going on to the other ways of creating value or destroying it. The next one is borrowing more money, that is taking on more debt or paying it down. And again, when you talk to the yahoos, you ask them, how do you decide how much money to borrow? And the answer is, I borrow every last penny that the bank will make available to me. Well, that's a great way to destroy value, because how are the banks deciding how much to lend? Well, they're looking at the value of the property. And if you're borrowing money to buy a property, then you're going to be able to borrow a lot more money at the top of the market. And that means you're going to be buying at exactly the wrong time and using as much leverage in making that bad investment as you can. Go back to what happened in 2007. First, Blackstone made a terrible investment by buying equity office properties. And how was their timing? They missed the peak of the market by 0 days. 0. But then Archstone Smith was bought just a few months later in an even worse deal. That deal was actually delayed from May until I think it finally closed in October. Why was it delayed? Because the financing was coming from Lehman Brothers and they were having trouble coming up with the cash. But Lehman Brothers, their pride was so wrapped up in that transaction that they insisted on completing it, and that triggered not only their own bankruptcy, but the collapse of the entire U.S. economy.
Wow.
So the decision about how much debt to take on, when to take it on, and when to pay it down is a critical part of creating or destroying value. So when I look at a REIT, one of the things I'm doing is saying, is this company willing to sell properties? Are they buying at the peak of the market, or are they selling at the peak of the market and using that money to do something more valuable, like paying down debt, so that at the bottom of the market, they'll be able to take on more debt and buy properties? The 10K and the other publications from the REIT are giving me an idea of, are they thinking correctly about how to create value? Now, I've only talked about 4 ways of creating value. Another 2 ways apply only if you are a publicly traded company, and that is deciding when to issue new equity and deciding when to buy back your equity. There is a narrative going around recently that stock buybacks are always bad things. That's not true. However, they can be bad things. If you are using your cash to buy back your stock when it is highly valued, that's a way of destroying value.
Mm-hmm.
However, if your stock is way down, which incidentally, the stock of REITs has been way down over the past several months, if you're doing a stock buyback and under those circumstances, that's a terrific way to add value for everybody, not just for the executives of the REITs. So issuing equity and buying back equity is a way to create value. When you're on the private side of the market, you simply don't have access to that way of creating value. Now, the 7th way of creating value, I never thought I had to mention, because it's managing the properties. The only reason that I realized I had to mention that one was years ago, I was watching a speech given at my alma mater, Yale, by somebody who had been working for an opportunistic private equity real estate fund and then went to work for a REIT. And he was saying, it's a big hassle. You got to manage the properties. I thought, oh my God, you've got a 10-year investment horizon, and it never occurred to you that between the time you buy a property and the time you sell a property, it has to be managed? No wonder your returns are terrible given the amount of risk that you take on. People in the private equity real estate business, their pride and joy is making deals, and especially acquiring properties. Now, they understand that they also have to dispose of those properties, but they really don't care about managing the properties. And so if you are in a position to manage your properties well, that means you're going to get good occupancy rates. You're going to get a good tenant mix. You're going to get a good ability to convince your tenants to stay on, even if you need to raise the rents. You're not going to have to sacrifice all of those non-rent enticements. So managing the property is a really important way of creating value, but you shouldn't have to mention it to somebody who's investing in real estate. But it is quite shocking that private equity real estate investment managers don't appear to consider it as an important piece of the process at all.
Well, I'm going to write those 7 ways to create value and destroy value into our operations manual. And I love to manage properties and I love to manage expectations. So I want to let our listeners know we are wrapping up. But here's the meat and the bones to it all. How can private sector professionals benefit from researching the REIT sector? Is there information arbitrage or other ways to create value?
Oh, absolutely. Here's the thing. Every day, information that comes out that may affect the value of properties. Why do stock prices go up and down? It's because information has come out that gives investors a little bit more insight into whether earnings are going to go up or down in the future. Same thing with properties. So if a piece of information comes out that tells us that multifamily property is going to be worth more, because, for example, the household formation rate is going up, which means there's going to be more demand for rental properties. What does that do to the value of every single multifamily rental property in the country? It means it goes up because the future net cash flows are going to be better. That shows up right away in the stock prices of publicly traded REITs that own multifamily properties. It's also going to show up in the reports that come out of investment managers on the private side of the real estate market, but not for about another year. What they do is they have to report values on their properties as appraisers report them, and the appraisal process takes months. And so if you're focusing on the private side of the market, then you're going to get all of the same information, but you're going to get it roughly a year later, unless you're looking very aggressively at transactions, in which case you're going to get it roughly 6 months later. It takes about 6 months to complete the transaction of a multifamily property. If you want good information right now, you need to be looking at what's happening to publicly traded REITs. And in fact, if you're an investor or an investment manager, you can create value by being among the early people to use that information. And in fact, I've never understood why people invest in open-ended funds on the private side without taking advantage of the information arbitrage between the public and private sides of the market. In other words, if REITs go down, the net asset value of an open-end private equity real estate fund is also going to go down 6 months to a year later. So why don't I get out of it right now? If REIT stock prices go up, then the net asset values of my open-ended fund are also going to go up 6 months to a year later. So why don't I shovel money in right now? I have worked with a friend of mine actually to develop an investment strategy to do that on a systematic basis. I think it is a future of real estate investment management. The problem is that in real estate, typically you have people who manage investments either on the public side of the market or on the private side of the market, and they simply do not look at that information arbitrage at all.
So what are your go-to life principles? You know, these takeaways, these eternal universal truths that you've learned, whether that's in life or in real estate.
I go back to something that I always tell students when I'm lecturing or guest lecturing. One of the biggest risks that you as an individual face is your own overconfidence. And especially if I'm talking to a class of graduate students, I tell them, what's going to make you overconfident? Well, one is the fact that you're getting a good education. You're going to think you're really smart. If you are successful in real estate, then you're going to think it's because you're really smart. And if you get rich, then you're going to think that happened because you were really smart. And you know what? You're not especially smart. There are a lot of smart people out there who are not rich because they took the same gamble you took and it went against them. Real estate, as you mentioned, is an inherently risky business. And so if you take the gamble and it works, people go around telling you you're smart. And I think, the truth is you need to keep a handle on your own ego, recognize that you're not as smart as you might think you are, and make your decisions accordingly. make sure that your decisions are building in a lot of humility, a lot of recognition that you may be making the wrong decision. That's, we talked about scouting, and that's one of the things that I reinforce whenever I talk to scouts about the personal management merit badge. It's just one of my favorite things to do in scouting, that and the family life merit badge. Make your investment decisions as if you're the dumbest person in the room. Because if you make your investment decisions as if that's true, then you won't get yourself in bad trouble. Whereas if you make your investment decisions as if you're smarter than everybody else, then you're going to be destroying value left and right.
Fantastic summary. I'm going to get a little bonus question here. Any industry resources, websites, books, must-attend conferences, or other suggestions you would have for multifamily market research?
Two things come to mind right away. One is that there are a couple of recent books that are really good, especially in the way they think about alternative assets, including real estate, though they're not real estate books. One is by a former academic named Andrew Ang, who now works for BlackRock. And another is a guy who also has an academic way of thinking, but has always been in industry as far as I know. And that his name is Sébastien Page, and that's a French name, Sébastien Page. And so they have written fairly recent books on investing that are really terrific, and I would recommend them. The other thing, you mentioned must-attend conferences, and there's really only one must-attend conference in my mind, and it is tiny, and it is by invitation only. And the invitations do not go to people because they have a lot of money to pass around. They go to people because they ask questions unceasingly. And that is a small organization called the Homer Hoyt Institute in West Palm Beach, Florida, that was set up by literally the original real estate market researcher. And the Homer Hoyt Institute gets academic real estate researchers together with industry people who think a lot. And they talk about these things. And that is why it is an absolutely must-attend conference. It's not a place where you're going to get an investor to invest in your projects. It's a place where you're going to hear people challenging the conventional wisdom and trying to come up with better answers. And that's why I go to that one every time I can.
That's wonderful. Well, I have two last questions for you today. And the first one is about multi-green and specifically locating your green. So in the spirit of multi-green, can you please tell the listeners a few of your favorite green things?
Well, one answer to that is very easy. I am sitting here at my parents' house in Honolulu, Hawaii, overlooking Manoa Valley, which is a residential area, but with a huge amount of green. And the house that my parents bought 65 years ago is located in what is now a forest reserve. And so there is green all around.
Wow.
And so I hope that that we will always be able to protect the kind of green that makes a place like Hawaii such an absolutely beautiful part of the world. And honestly, when you're talking about making multifamily housing sustainable and attainable, that's critical for protecting the green in places like the valley that I'm looking into right now. Another, when you mentioned just the color green, I go back to an exhibit I saw years and years ago of Mark Rothko paintings. And I think I'm like lots of people. I didn't get Mark Rothko. Like, what's the deal with these big rectangles of color? And I sat there in front of a painting that was 3 different shades of green. And I thought to myself, I get it. Now I understand what this artist was trying to convey, what he was trying to accomplish. And it was this epiphany. I had been in front of other Mark Rothko paintings and I just didn't get it. But in front of this, I've never forgotten this one painting that was all green because it was the one that finally made that particular artist's work make sense to me.
It's so great to see your thinking and the refinement and the articulation. That was a really great response. Thank you.
Well, I appreciate it.
So now it's the end of our podcast, and it is the end of 2020. And Multigreen started this year by launching from Davos, Switzerland at the 50th Annual World Economic Forum. And on the global stage, we committed to improving the state of the world by constructing 40,000 attainable, sustainable, and tech-enabled multifamily homes. If you had one wish for Multigreen, what would it be?
I think that's easy. I would say my wish for Multigreen is that not only that you be able to achieve that goal, but that your attainable, sustainable, and tech-enabled multifamily housing units help to integrate the people who need housing to be within their reach financially, help to integrate those people with the people who don't need special attention in terms of making housing attainable to them. Unfortunately, over the last 80 to 90 years of land use restrictions in this country, a lot of what we've done is to separate people. I think that in order to make housing truly sustainable as well as attainable going forward, we're going to need to develop ways of bringing people who are different in their ethnicity, different in their educational attainment, different especially in their financial capabilities, together as neighbors to be talking to each other face to face every single day. That is my wish for Multigreen.
Brad, I'm going to do everything I can to make your wish come true.
I appreciate that. The world will be a better place if you're able to accomplish that.
And Las Vegas will be a better place too if you come here. Brad, it's been great having you.
I've absolutely enjoyed it. Thank you for having me.
Thank you for listening. Join us as we build 40,000 attainable, sustainable, and tech-enabled multifamily homes by 2030. And if you like the content you're hearing, hit the subscribe button. Follow us at Think Multigreen and sign up to learn more at www.multi.green.